Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm 𝗤𝘃𝗃𝗀𝗃. With me, as always, is Mark Ainley. Mark, how are we doing over there?
Chicago West Suburban Real Estate Investors Group. You and me did our first duo presentation on Tuesday. What did you think? How do you think we did?
I thought we did all right. You know, I'm ready to be in person, right? Like there's another Zoom call. And John Warren does a great event. He has the breakouts. We have it listed on our website. So, you know, if you're interested there, even if you don't invest in those areas, he has a lot of great guests, you know, current company excluded, but he does a good job. And I thought we did pretty well, right? I thought we provided value. I got good feedback from it.
Yeah, no, I got, I'm not sure about you, but I got a handful of people that reached out and we got a handful of reviews on the podcast. So I think we provide the value and I think we got the reward for our time. So it makes me happy with that. So.
Yeah, I guess it goes without saying, like, we're always open to having those conversations. So if you're running some sort of meetup, some sort of group, we're pretty open. We like talking. We do it we do a podcast. Obviously we like this.
Yeah. No, we did it pretty animated too. Hopefully we weren't boring. So if anyone thought we were boring, just keep your opinion to yourself.
Yeah, we have soft skin. Don't hurt us.
We're only talking about right now to help our own egos. So that's why we brought it up here.
Yeah. So that was good. We're check out our website on the resources tab. We have all the different events. If you have an event and it's not up there, let us know. We'll promote the hell out of it. Throw it up there. We want you guys to succeed. So I'll move on. What's the housing provider tip of the week?
Housing provider tip of the week. Right now, this is going to air probably mid-March, end of March, if not first week of April. But if you have been waiting through the winter months to get those spring projects done, you're already behind the ball. So a lot of people, you know, for us, you know, rental license work that we have to get delays on, or Section 8 will give you weather delays. Those are things that even though you don't have to do them till April or May, you should be planning for them in March and February and April. So if you're too late this year, make sure you're better prepared next year. But keep this in mind, in the winter months, the people that do the outside work, the chimney guys, the tuck pointing guys, the siding, the roofers, they're pretty slow. They're a little more flexible. And if anything, what they like to do is plan out their spring. So first in, first done type mentality that you could get work done. And but if you go to them in June when they're slam packed, they're probably not going to give you as aggressive of pricing as well too. So keep it in mind for your spring projects, stuff that you're putting off till it gets warmer out, the weather gets nicer. Plan for it ahead. That way you could get it done right away, early spring.
Yeah, it's a good tip. I would also just say for anything right now, the supply chain is so goofy. We have custom cabinets that we ordered in the beginning of February and we're being told end of May. And it's like, oh, sweet. Now, you know, that's a much longer lead time than we're used to. So, you know, yes, for the spring, but for anything right now, just be proactive. If you think in the past, if it took you 4 weeks, it might still take 4 weeks. It might take 8.
Agree. Especially when you like you said, when you're building out your construction plan and all that stuff, allow that, because if you have to wait 4 weeks longer for those windows to come in that you thought you get in 10 days, then that screws up your entire project and literally costs you thousands of dollars extra in carry costs.
Yeah. No bueno.
No bueno.
All right. New topic for us.
Yeah, definitely. New topic. I know the concept of it. And I know we have clients that we manage for that have this type of setup. So I'm excited to learn more about it. And then if anything, be able to grow with it. Our guest today, he's a senior member of the business development team at Midland IRA. He's got over 15 years of experience with alternative investments. He specializes in private placements, real estate, and other non-traded assets. His primary role as new business development for Midland self-directed IRA services. He works with various capital raisers, advisors, investors, and other financial service providers to provide delivery custody solutions. That was very scripted. So if anyone couldn't tell, but without further ado, we want to introduce Adam Sypniewski. Did I get it?
Thanks, Mark. Thanks, Tom. Happy to be here.
I got the name right? We're good.
You did. You can you've passed the Polish exam now.
For anyone listening, Tom, right before we started, Tom's like, hey, Mark, you know how to introduce his name, right? You know his name? And I got all nervous and flustered at that point. So I had to spell it out. But Adam, welcome on here. We're excited to have you on here because, you know, anytime we have a topic that we haven't talked about before, it's good for our audience, but it's also good for people like Tom and I that, I think we could ask more curious questions on things.
Sure. Absolutely. Happy to be here. Thanks again for having me, guys. Excited to get into it.
So we're going to dive into detail in the show, but kind of give us an idea of what I guess start this. How'd you get into this?
Yeah. So, I mean, yeah, it was, this was more of a 9-to-5 gig for me, coming out of school. I entered straight into this IRA, self-directed IRA space. This was, just around the time of the financial collapse of 2008. So there was a lot of folks looking to diversify and get out of the markets. And so self-directing, as we'll, reveal, has a lot to do with diversifying our retirement assets away from the market. So given that was a time to diversify, being 2008, it was an exciting time to enter the industry, and it's been a fruitful journey for me. And so I've really deepened my experience over the last 15 or so years, and have had the opportunity to work with not only a couple different providers in the space, but also, the greater slice of American pie that is raising, capital for private deals. And so it's been an exciting journey for me.
Cool. So a lot of our listeners, raising capital is a big thing, right? They buy their first deal, they buy their second deal. At some point, they're looking to bring in partners. Before we dive into the tactics, can you just explain what is an IRA, right? Yeah. What is an IRA? Who has one? What's the benefits? And we'll go from there.
Yeah, no, that's great, Tom. Happy to. So IRA stands for Individual Retirement Annuity, actually, not individual retirement account, but we can throw that to the side. We all think of it as an account, right? So basically an IRA is a way for all of us as taxpayers, U.S. taxpayers, to run our own sort of retirement vehicle. A lot of us, that are W-2'd, have an employer that will provide us benefits. Most often that includes like an employer plan, like a 401k, right? That's an employer sponsored plan. If you want your own plan, you got to open up an IRA. And a lot of times, we can fund those a number of ways, but an IRA is really just me, Sypniewski, having my retirement account to, invest and plan for, when I, pass the age of 59 and a half and later. So really all that is, it's a tax sheltered vehicle in most cases, where we can invest in both public and non-public investments.
Got it. So I believe I've been on both sides of this. So a couple things. One, I used to have a W-2 job. It's a 401k. It gets rolled over. That money then that's kind of primed to go into one of these IRAs. Is that correct?
Yeah. So when we have a 401k with an employer, when we have a separation of service, Tom, like in your circumstance, it becomes what we call portable. The 401k is then portable, meaning we can roll it over into an IRA, and that's not a taxable event. And it's probably the most common way that folks set up an IRA because, they've worked for 10 years for an employer. They have a pretty big chunk of cash. They're either going to take that 401k and bring it to their new employer plan, or they're going to just take it out of the plan altogether and go and do their own investing. And so that's where we most often see, in terms of how our clients fund their IRAs with us, that's what we see the most. They're rolling out of a plan because they've been matched by their employer for a number of years. They've built up a considerable balance to go and do something else with it in their IRA.
So a few self-serving questions here, and then we'll get back on topic. But I think this will be helpful for the listeners. Mm-hmm. So my understanding is that IRA that I personally have, I can't use that on my own investments that I'm active in, right? That my own deals that I'm doing, there's limitations. But then I know on the other side of this, I'm currently working with someone now who invests private capital with me, and they're pulling it from their IRA. And now me on the other side of the table, I don't really know the mechanics or care really that much, but I know that they're able to do that through me because they are completely passive. I'm not able to take my own IRA though, and put it into my own deals though, because I'm active. Is that an accurate statement or an accurate summary?
For the most part, Tom, yes, but there is nuance. I wouldn't say it's black and white. Now, I'm not a legal advisor or anything like that, but there are ways that we can use our own IRA money in our own deals, provided there are other investors in the deal. We will certainly probably get into this as we kind of separate this conversation into the IRA investor and the raiser that's bringing in IRA money. But there are ways that you might be able to use your own IRA money towards your own deals, again, provided there are other outside investors in the deal. We have to make sure that the cap table is diluted enough to where you and your IRA aren't owning the majority of the deal. or along with any other disqualified persons is the term. But again, that's some nuance that we can kind of uncover as we go through the conversation here.
Okay, cool. So let's start with a more novice investor, right? We understand like a syndicator, they target these people, they get them in there, and they're raising millions of dollars. Most of our listeners are not on that level.
Sure.
But they could look to use, Uncle Jim, who's got an IRA, to fund the next 6 unit or whatever that may be, right? So let's talk through first the benefits from the person who has the IRA. Why would they want to put some of that money into real estate as opposed to, hey, the stock market's been doing fine, I'm good over here? Pitch is the wrong word, but what is the benefit to them to taking that capital and putting it as either a private capital into an investment on the equity side or private capital on the debt side, et cetera?
Yeah, great question, Tom. So our service and self-direction in general is best thought of as a way to diversify our retirement portfolios. Okay, I think, at the time of this recording, I think it's especially relevant because there is a lot of market uncertainty based on some certain geopolitical events that are occurring right now as we speak here in, late February. So that might, change our portfolio mixes in our, IRA at Schwab, holding equities and the like. So if folks that are, skilled and sophisticated in real estate and they understand that market, they can use their retirement account to invest in it. They just are diversifying away from, the public markets. And so that's a, a typical profile of one of our clients is they'll slice off, not maybe all of their IRA, but a portion of it, 50K, 100K or something like that, to put it towards the deal or to buy a single family home or to involve themselves in a syndication. Again, it's diversifying away from the market. It's not so much a way to benefit yourself personally. We have to remove that off the table. You want to see it as a way to diversify your retirement portfolio into an asset that maybe it's a local development that you're comfortable with. That's the way to think about it, is investing in something that you yourself know is going to be a good opportunity for you.
Question: historically, how long has IRAs as a financial vehicle been around? And have you always been able to do what we're about to talk about as far as real estate investing, or is that something newer? And if so, when did that come into play?
Yeah, great question, Mark. So ERISA, was a law that was passed in 1974 that created the IRA vehicles, and Roths came later. So mid 70s, we've been allowed to, plan for our own retirement because, as you could imagine back, in that time, Social Security was starting to not be maybe the security blanket that we all thought it, was at the time. So IRAs were created to help us start preparing for our own retirement years. And the second part of your question, Mark, it's never been when have we been allowed to invest in real estate since IRAs have been created. The beauty about IRAs is that they don't really disqualify investments, types of investments. There's really only 2 that you can invest in, by the IRS rules and regulations. That's collectibles, so things like rugs or bottles of wine or baseball cards or classic cars, things like that. Or life insurance policies. Those are the only 2 things you cannot hold in an IRA. So the rest of the investment world is your oyster here. Really, IRS language prohibits who you can invest with, not what you can invest in. And there's a list of what are called disqualified persons that we might talk a little bit about. But to answer your question, Mark, we've always been allowed to hold real estate in our IRA.
Got it. And then what are some potential limitations, right? We've talked about some of the benefits. It sounds, there's tax advantages here, there's diversification potential. What are some of the limitations of investing through an IRA versus just, I have this money in a money market and I'm going to liquidate it?
Yeah. So, it's depending on your age, it's capital that you can't exactly access for a number of years. I'm in, my mid 30s, and anything that I'm doing in my IRA, I can't really touch until I'm over 59 and a half without getting penalized on it. So, if you're looking for, some liquidity, near-term liquidity, it's not going to be the vehicle for you if you're in your 30s, 40s, maybe even your 50s. So, that's one thing, Tom, that comes to mind. and it might be the only thing that comes to mind as we kind of go through the conversation. Maybe some other limitations come up, but we touched on those disqualified persons who you can invest with. You're limited there, and then again, accessing that capital, being able to realize those gains, or at least have that liquidity that comes from that gain in a given deal. You're not going to be able to touch that until you're of a certain age, 59 and a half or older in most cases.
All right, so let's break this down here. So you have for our listeners, there's these opportunities here. We can kind of almost put them in buckets. You have if you hold your own IRA, we'll talk about what they can do with that. And then there's if you are trying to get other people to invest in things, you could go to people that have an IRA and get them to pull that out. So kind of starting with the first one of if you have an IRA right now, say one of our listeners is working a W-2 job, investing on the side, but trying to grow their portfolio. Walk us through kind of what their opportunities were. If I came to you right now and said, I got an IRA, I want to invest in real estate, like what should I be looking at? What should I be considering?
Yeah. So, what kind of structure are you looking at? Are you looking to purchase, a single family home and landlord out of the IRA? Are you looking to be an LP in a syndicated offering? Are you looking to lend? Because all of those things can be done. So, in my role and in the self-directed IRA world, we're not fiduciaries. We're not here to tell you what to do or what's a good investment or what's not. We're very passive. We're not a fiduciary in this role. So, Mark, if you came to me, I'd be like, well, let's talk about what you're seeing in the market. What are you looking to get into? And so, I think it's really led by the investors' desire or whatever they're looking at from an opportunity perspective. Are they looking at a piece of property? Do they know somebody that's raising money? And it's not until a deal is actually on, within the realm of their possibility that they want to start making moves to use their IRA towards it. But the biggest thing that you want to keep in mind, Mark, is, do I have an IRA today? And if I don't, do I have an old 401k that I can roll over into an IRA to use the self-directed vehicle?
So so it sounds like you read off a few. It doesn't sound like there's many things that I couldn't take my own personal IRA and invest those funds into. So you said single family home. You said I could go invest into a syndication. I could pull the money out and be a private lender to Tom. I mean, it seems too easy. Like what are the hoops that you have to jump through, or like?
Sure. Well, there's mechanics behind everything, right? And so given that most self-directed custodians aren't, they're not the Schwabs, the TD Ameritrades of the world. These are typically smaller business owners, smaller businesses, and we have to, there's moving parts. So, we, as paperless and immediate as we all like to be, there's still time involved. We might get to this later in the conversation, guys, but we do need time for money to move and for documents to be executed. Just like when we're closing on a property, there's certain documents and I's that need to be dotted, T's that need to be crossed. Even more so with an IRA, we need a little bit more lead time. That's probably if I could communicate anything and to this audience, is that if you're looking to use your IRA for something, make sure we have 2 or 3 weeks lead time to make the moves necessary. That's probably the biggest hurdle, Mark. Again, if the capital is accessible, meaning your 401k is portable, or you have an IRA today, we can make things happen pretty, as long as there's a paper trail, we can likely get it done. We'll just need a little bit of time.
Just take a step back here, because I want to clarify. Yep. There's multiple different types of IRAs. You mentioned Roth, and this is a specific one that you could do. And this is self-directed IRA. Is there other type of IRAs, and would you be able to do anything like that with this, or is this limited to? Correct me how I'm wrong there.
Yeah, no. So self-direction isn't. It's a marketing term, more or less. It's not a tax status or a legal term of an IRA. It's just a term that we all use in this market to, communicate that the IRA holder is empowered to pick and choose and find their own investments. We're not going to give you a list of funds, of equities or ETFs or mutual funds to pick from and say, here, pick one of these things that we broker. You tell us what you want to invest in. We'll self-direct your traditional IRA, which is a pre-tax IRA. We can self-direct your Roth IRA, which is a post-tax IRA. Or for the business owners, that are on the podcast, there's what are called SEP IRAs. There's also simple IRAs. That's kind of a thing of the past, but the SEP IRAs for our business owners, along with individual 401ks, which is another rabbit hole we can go down to. But the point being that any of these retirement vehicles that we have can be self-directed. It's not a legal term. It's more of a marketing term, just to say that you're empowered to find your own investment opportunities in the market.
Cool. I appreciate you breaking that down. So I'm going to walk through a scenario and you tell me where I go wrong. I am an investor. I call up Tom. He's my broker. Tom's going to take me, show me out a 2-flat building. I have my own IRA already. And my goal is to write an offer on that MLS listing this weekend and do a 45-day close. Like, where in that is that different from a traditional, or is it at all, or where do you come into play, or talk me through that scenario? Yeah.
So the thing for real estate purchasers, the way to think about it is using your IRA for an all cash close. There's typically no financing involved. We can get to it. There's a way to do it, but again, we'll get to kind of that nuance, but 45 days, not an issue. If an IRA today, you'll need to make sure it's liquidated or it's in cash wherever it's at today. So we can open an IRA for you that's self-directed, bring cash from that other IRA into it. And that is going to be the purchaser on the title and on the deed of the property is going to be, Custodian Trust Company, FBO, Mark Ainley IRA. That's the purchaser. It's not Mark. So you don't want to put on a down payment or an escrow payment. That all has to be funneled through your IRA. So all your out-of-pocket costs and things like that, you can't just go around paying vendors and things like that, or title companies. All those closing costs would need to be paid by your IRA, along with the full purchase price of the property comes from the liquid cash sitting in your IRA.
Gotcha. Okay, that makes sense. We've actually had to redo contracts before for people that bought properties from us because of that. The contract had to read the specific name of the IRA. So that's with kind of a property like that. Like, what if I just want to pull out the money and be a hard money lender for a flipping business? Like, how? Yeah. I mean, can you just go put the money on the street? I mean, like, do they have to know where you're putting it? Like,
quick, let's just take a step back. Can you just explain? It's probably worth explaining to our listeners that investors can be on the debt side or the equity side of the deal, right? Mm-hmm. So taking a step back, they can be on the debt side, meaning they're just a private lender. They're going to get a return every single month for the money they invested, and they really don't care how well or bad the property does or the profits are. They have a set return. They're basically acting as the mortgage company would. Then on the equity side, which is what we see in the syndications, they have the upside in the deal. They have, as I said, equity. Right? Their returns are going to be more volatile. They could be better, they could be worse, et cetera. But it sounds like with this, you can invest both on the debt and the equity side. I want to get that point across. Yeah. Is that accurate?
Accurate. Yes.
Okay. So now that we've established that, going back to Mark's question, what has to, if someone wants to be a private lender, or if I'm looking for, I'm out there as an investor looking for someone to be a private lender, because it's a question we get all the time. Who do I go target, and how do we, like, the mechanicals to how to actually make this work? If two people agree, I will do it for this percent, this return, what happens next?
Yeah, it's a great question, Tom. So earlier I mentioned, we just need a paper trail. That's a little flippant, but, in the case of hard money lending, there needs to be a note. A note needs to be drafted where the IRA is the lender, making this loan to the borrower at a, rate and a maturity date that's listed on the note. That note, again, is held by the IRA. And, I don't know if the listeners are aware of, these legal documents, promissory notes that get created, but we would be, the custodian would be involved. The custodian that's holding the IRA for your benefit would technically be the lender and send the cash out of your IRA, but it needs to be backed by a piece of paper. I think, Mark, you said you can't just go off on the street finding somebody and we're just going to wire somebody some cash out of your IRA and hope you get a return on it. That's not how it works. There needs to be a little bit of we don't go as far as say a due diligence, but we do administratively review our client deals to make sure it's feasible to hold in an IRA, meaning, if it's a lender in this case, that they know that they're borrowing from an IRA and that you need to make your payments back to the IRA, not to the individual. You need to make sure P&I is all coming back to the same place where their IRA is held. And then when the note has lived its life cycle, it's, we're sitting on cash in an IRA as opposed to that note. If you're looking at an equity deal, Tom, something like an operating agreement that has a schedule of members, that are coming into the LLC, we would get involved in there where we, take the scheduled member isn't, Tom, it's Tom's IRA. So again, there needs to be some sort of paper backing the deal. I'm sure a lot of your audience has dealt with notes or operating agreements before, but that's where the magic sort of happens. That's what our kind of back office, you'd call it, looks at when supporting our client transactions.
Got it. Are there any pitfalls here from a regulation standpoint? So like when you're raising money and it's got to be an accredited investor, it's just, it's an actual security exchange. Yeah. Anything we need to be aware of if we're looking to put a deal like this together when someone's investing from their IRA, besides the paper trail you mentioned, any other regulations to note? Yeah.
So, regulations, I think the disqualified persons list is especially important to bring up right at this juncture, because the IRS, again, as I said earlier, doesn't so much dictate what you can or cannot invest in. It's about who you can or cannot invest with. And so they have this list of what are called disqualified persons. And, you asked about earlier, Tom, can I invest in my own deal? Well, most of the times, no, because we are our own, ourselves are disqualified to our IRA. That's the first disqualified person, is yourself to your IRA. So Adam's IRA cannot pay Adam for anything. But also disqualified to my own IRA would be, my spouse, my parents, my grandparents, and my children and grandchildren. So up and down the family tree, lineal ascendants and descendants are disqualified persons, along with ourselves and our spouses. So you need to be aware of that rule, if your IRA is involved in any deal. So, Tom, if you're raising money from, your parents or your children, you need to be aware of those rules. Again, there's some legal gray areas around those, but those are the pitfalls that you want to be aware of. And again, a custodian does need to be involved. So, like Tom or Mark, you can't just, fill out the paperwork yourself and, say, oh, I put Mark's IRA on the doc or on the note, I'm good to go. No, there's tax IDs that need to be used as opposed to like social security numbers and things like that. So you need to engage a custodian to keep your tax shelter in place, and you need to be aware of who you're investing with. I'd say those are the two biggest pitfalls to be aware of.
Got it. Good stuff. All right. So let's talk about just the opportunity here, right? Because this is huge. People, everyone's chasing, there's a lot of capital in the market, but we have a lot of listeners who are probably chasing capital themselves, because that's the next step. At some point you do enough deals and you need to bring in other people. Mm-hmm. Give us an idea. Like, is there just like trillions of dollars sitting there in IRAs that can be put to use in this matter? Like, right. It's like a ginormous number. No? Yeah.
It's something like, our marketing materials might say it, but it's like, something like 8 trillion or 18 trillion or something. And they're always, the prediction is always going up, that the ocean is expanding in terms of the cash sitting in IRAs. Again, 1974 until now, cash has just been accumulating in these types of accounts.
Yeah, man. So where do you have any, and maybe this is going to a little out of your realm, but where should people be? Are there specific individuals besides the family, friends, network, the usual? Are there specific target points where someone would be more interested to invest in real estate through their IRA?
I don't know if I can give you a good profile there, Tom, but I would say that the way to think about it, if I'm a capital raiser, is, I know advertising rules are strict. You have to have relationships with people already. So if you've raised money from a specific individual before that you already have in a relationship, have that relationship with, their IRA is another investor that's already in your network that you haven't even tapped into. It's a capital source that, you could potentially double your existing investor base based on the people you already know by just considering their IRA as another investor. Now, in terms of who has the taste of getting into real estate, I'm not sure I can give you a hard and fast answer there, Tom, but I can tell you that most people that are going to self-direct their IRAs have been in these are high net worth people in most cases. They're white coat investors, they're doctors, or they're, someone who's been in the tech scene for a long time and has built up a considerable 401k with a startup or other, big tech company or investment banking company. And they're in their 30s or 40s and they're changing jobs and they have this big 401k that they're wondering what they're going to do with. Well, stick it into your deal. That there might be 50, 150K or more sitting in their that old 401k. They could just roll into an IRA and put towards your deal. So I can't give you a good, who do I look for? Because there's not, people just, there's no, while I wish there was, guys, there's no kind of community out there that says, I want to self-direct my IRA. What can I look at? It's just, who knows about it? There is an awareness gap there. So that's why I kind of start with that whole, who do you know? You split them into two, themselves and their IRAs. There's two investors at that table when you're talking to one individual that you know.
All right. So money's flowing in. So either you're going to lend your money privately, you're going to get a draw on a syndication, you're going to get rent coming in for your single family. How does that work? Does that money have to go right back into the IRA on a monthly basis? Talk to us about kind of the money coming back in and how accessible it is, if at all.
Yeah, no, that's it. It could be a pitfall, but when you're working with a custodian, that's going to be like, rule number 1A is that cash flows, returns and proceeds have to come back to the IRA first. If they don't, if they go to the investor, that's considered what we call a distribution from the IRA, which would be a taxable event. If you want to keep your tax shelter in place, whether it's rental income, monthly rental income, that check is payable to your IRA, comes back to wherever your IRA is held. If you're, getting a quarterly dividend from a syndicated offering, has to come back into your IRA, has to be paid to the IRA. We provide whoever the deal sponsor is delivery instructions on where they might send that, but they would know that based on, the subscription document or the LLC, operating agreement or something like that. They'll have that when you've come into the offering. But for, those landlords that are listening, yeah, your renters are going to send a check to your custodian, and that's rule number 1, because if it doesn't, then you're going to get taxed on that. And if you're under 59.5, you're also going to get hit with that early withdrawal penalty.
Well, how does that work for expenses? Obviously you buy a house and you might have, between your mortgage and everything, you might have 80% expenses or whatever on that. How does the money comes in? Maybe you pay out your expenses and then the balance goes into that account. Like, how does the logistics of that work?
Yeah. So,
or you're saving up money for CapEx items because some of that rent money's got to go towards a new roof.
Right. It's a great question, Mark. So yeah, that those incomes, those returns, or just wherever cash has come from. Maybe you've made some contributions to the IRAs over the years. It's important. It's needed because yes, when we landlord or hold a property, a single family home or the like in our IRA, there are expenses, property tax. There's just maintenance. There's putting a new roof on, getting a plumber in there. All those expenses are the responsibility of your IRA. So just like the incomes flow back into the IRA, all the outflows, the expenses, recurring or not, all must be paid from the IRA. So if you don't have the cash in there, you got to get it in there to pay it, or you're going to find yourself in a taxable situation. Because the name of the game when it comes to our IRA is just sheltering from any sort of tax liability. And so when those types of things happen where we pay an expense out of pocket or take a rental income payment, and deposit it personally as opposed to our IRA, that's when those taxable events start occurring. Those are when hiccups occur.
So do you almost have like an IRA operating account basically with those in the debits and credit or the income and expenses, and then ultimately the balances can't leave there?
Yeah. So there's as we've kind of educated the audience here, there's another mechanism that I think is most relevant for hard real estate investors, and that's what we call this checkbook control feature with IRAs. What we've talked about to this point, guys, is holding investments directly within our IRA. I took you, or I can't recall if I think it was Mark. He said you had to redo like a sale agreement to get in the name of an IRA. That's what a lot of people do. But for some of the more sophisticated folks out there, there's what's called checkbook control, and that's like what you just described, Mark. That's where we actually, it's done. The kind of behind the scenes work is what we do is we set up a single member LLC for the IRA investor, where the single member of the LLC is the client IRA. And that works much more like what you're describing, Mark. And that would, for, again, hard real estate investors, it might be the way to go because you have this checkbook control, which basically means you have check writing authority to pay those expenses that we talked about, those property taxes, pay your plumber, pay your electrician. You'd receive your rental income payments into that LLC as opposed to the IRA directly. So it's an LLC that's held underneath the umbrella of the IRA. Again, there's a lot of nuance there, but again, for the audience to do their own research, checkbook control IRA is the term that you want to use, because again, it's like it's basically like your own operating account, Mark, like you use to do all your investing, receive your incomes, pay out your expenses, X, Y, and Z.
Got it. So that's helpful. So I want to further complicate this now. And we don't have to get too in the weeds, but let's say Mark and I are going to buy a property together, right?
Yeah.
We form Mark and Tom LLC, and we go buy a 10 unit or whatever it is. My portion, I'm doing just typical cash. Mark's pulling his portion from, someone's IRA, his own personal IRA, someone else's, some way or another that, one way that it's legal for him to do.
Okay.
Then do we just set up, how does that work? Because the way you just described it made perfect sense for an individual. Mm-hmm. Now we have two people contributing cash and two people getting distributions. Is there just an intermediate step then to make sure that because everything would go to the LLC, and then is the further step, like that distribution goes to Mark's IRA. Is that how that would work?
Yeah, exactly, Tom. So, the situation I described is again, more for folks that want to landlord. This checkbook control is more, in my opinion, my experience, is more for people that are fix and flipping, holding single family homes for a certain amount of time and moving on. When it comes to like a multi-member LLC, Tom, like you described, that we would just invest the IRA directly into that LLC. The LLC does its own thing, and then the returns and the redemptions come back into the IRA. So the scheduled member on that, that Tom and Mark LLC that you described, well, there's Tom Shallcross, and then there's
Mark's IRA.
Right. Mm-hmm. So that would be the other member of the LLC and any other outside investors that you guys might have. But that's how we would accomplish that piece.
Got it. Man, that opens a lot of opportunity, right? Like I know, and maybe I'm just like excited because we're talking about this topic, but that's a whole lot more money for, people who have had successful businesses or successful W-2s. It's just a whole nother world, right? It's not cash on hand. It's this retirement cash they're not touching anyways. Might as well put it to use in a different mechanism.
Yeah. I mean, the philosophy, a lot of these self-directed IRA investors is, my investment horizon is a lot longer. So I'm willing to either take a little bit more risk or I'm comfortable waiting a little bit more of a timeline for a higher yield. So yeah, as people accumulate these balances in their employer plans, you're exactly right, Tom. I mean, you just have to know about it. There is an awareness gap about this type of thing. Again, it's been around for 50 years, but people still don't know that they can hold real estate or lend out of their IRAs. And it's luckily that trend is kind of changing. But yes, there is a lot of opportunity not only for investors but for capital raisers as well.
All right, Tom, you've been very optimistic, so I got to ask the dark question. I lend the money from my IRA. I take the money out. I lend it privately, or I do a bad real estate deal, and ultimately I lose that money. What happens at that point? Is that just a taxable event then for me at the end of that year? Talk about the downside of
So when we use our IRAs, we're sheltered, from cap gains and the like, and all that, all those types of taxable events. On the downside, Mark, we cannot write off losses. So again, because we're tax sheltered. So there's no sort of taxable event, so to speak, unless you're, over 59 and a half and you're looking at RMDs and things like that, but, 72 and a half and you're looking at RMDs. But when, if you get in a bad deal, I mean, that's the risk of self-direction, so yes, there is a way that deals can and have gone bad. As I said before, your custodian is not going to perform a due diligence. They're not in a fiduciary capacity. So if you want to, if you're wary about lending or looking at a specific deal, you'd want, your advisor, your CPA to do some due diligence, because that's not our role. Again, this self-directed product is for folks to go out and find their own opportunities to do their own risk assessments. We're not in a educated capacity or licensed capacity to say, hey, you're suitable for this given offering, or this is a good return based on your income and your age to go to retirement. Just not what we do. All what we're focused on is making sure your IRA is in accordance with IRS rules and regulations. So if a deal goes bad, Mark, it's that's a down year in your IRA. That's 2008. For a lot of people, that's money just gone, and it's sad, but it is truth.
So it's no different than just you bought a stock or a mutual fund and it took a nosedive and you just have less wealth in your IRA. You don't get like penalized for an early withdrawal because the money's not going back in or anything like that.
No, you're penalized enough.
Yeah, right. No, there's
no additional penalties or anything like that to be looking out for in that case.
Gotcha.
Adam, you referenced the tax shelter there, and it just occurred to me, it seems like you wouldn't be able to double dip, meaning you're tax sheltered, but then like you wouldn't get the benefits of depreciation and some of these other benefits of investing in real estate, right? You can't be tax sheltered and then also pick up the depreciation aspect of the, okay.
Right. So there's kind of a double dip effect that you can't write off the capital losses or anything like that. It's the same thing with depreciation. Again, this is like while your IRA is holding a property, there's no your IRA is its own kind of entity, right? And so we report to the IRS what your IRA is doing, but market value changes and things like that are only reported to the IRS. When we're under the 59.5, it really is just a matter of kind of like record keeping. When we get over that age of 59.5, and then especially when we get over 72.5, we have to start taking cash out of our IRAs because Uncle Sam wants to tax you on that money at some point, right? And so those are the circumstances where I say, well, I can't write off the depreciation, but we're in a market, kind of downturn. Well, you can take less money out of your IRA, but again, these are just value fluctuations at the end of the day of our holding account. So depreciation and other things, there's no way to write it off because it's in your IRA.
Makes sense. Got it.
Before we move to the wrap up, anything else you want to put out there? Anything we didn't cover? Any best practices? Any pitfalls? Anything that our listeners should know?
Yeah, just again, in summary, make sure you know who you're investing with. And if it's a close family member, make sure there's disqualified persons rules. Make sure you give yourself enough time, 2 weeks before closing, at least, maybe a little bit more. And then make sure you're working with the custodian if an IRA is involved, because you need one. Otherwise, you're going to get a huge tax headache that's not going to be worth it. And it's going to, blow up in your face. So broad strokes, that's what I'd want the audience to keep in mind. Time, who you're dealing with, and involve a custodian.
All right. Awesome. All right. Let's move to the wrap up. So, Adam, what is your competitive advantage in this industry? How have you been able to help more people in this scenario than others have?
So we align ourselves, at least my philosophy is I try to find more of the capital raisers in the space because, in my opinion, there's less friction when you're a passive investor using your IRA. It's really hard to landlord. Hard money lending is okay, but in my mind, the best way to utilize your IRA is being a passive investor in a deal. And so, kind of my philosophy has always been to find those capital raisers. Find people that are maybe they're in multifamily, maybe they're commercial real estate, maybe whatever it might be. They're people that are putting together deals to raise money from outside investors. That's what that's who I'm trying to find. And so we make it easy for the raiser to bring in IRA money towards, into their deal, because it is a cumbersome process as we've kind of uncovered. We want to make that easy for the capital raiser to fund their deal, to capitalize their deal. And so we've done everything in that vein, from talking to them, knowing what's important to them, because we don't sell our own investment products, right? You can't go down the street and say, hey, Mark, you want to open up a self-directed IRA? Sure, Adam, what am I going to invest in? Well, I don't know, but so you can see that that's not really a good business model for us. So we try to cater to the capital raiser and then make it easy for their client to get through the process as quickly as possible.
Got it. Adam, what is one piece of advice you would tell someone that is yet to buy or invest in their first property here in Chicago?
Know your tax code, right? I mean, that's about it. I mean, I've not sit in the seat myself. It's kind of hard, Tom, but I would say, if there's one thing to keep in mind in Chicago, especially Cook County, it's just, know your county, know your taxes, know your tax code. Again, with an IRA, that's not something that I see very often, but that would be where I would probably start as an investor myself. And
reach out to our friends over at 𝗫𝗄𝗃.
Yes. Great. What do you do for fun?
What do I do for fun? Well, I'm usually trying to cook something delicious for my family. Emphasis on trying. drinking something responsibly and watching the Bears, White Sox, or Michigan State Spartans.
No, it might be our first Sparty on the episode.
I forgot to put that in. I saw that in the bio after I finished reading it off.
All right. What is a good book, podcast, or self-development activity that you would recommend to our listeners?
Yeah, so I'm a reader. Right now, I kind of stumbled upon, and this is, I don't mean to, this is not for religious purposes or anything like that, but I stumbled upon a book that is an intro to Zen. And I think that it's called Dropping Ashes on the Buddha, that I'm reading currently on the metro back and forth from the suburbs. And coming in and out of the city, learning how to detach and center has been very beneficial for me. And for those that are curious, I definitely recommend it. It's called Dropping Ashes on the Buddha. It's a book that I've found some benefit in.
Nice. I like it. Besides yourself, name one person in your local network you'd highly recommend to other investors as a quality resource.
Oh, let's see. Another resource besides myself. I would have to say, let's see, there's some CPAs in town. I don't know who you guys have typically covered, but there's a number of CPAs here. Trying to think who's the one in the real estate space that I could help out here.
Or let down by not remembering his name. Either way.
Yeah. Well, it's like who do you want to help, right? Can I take a pass on that one? I don't know that I want to promulgate anybody or
Well, if you come up with somebody will add it to show notes.
That sounds good. Thanks, Mark.
And thanks so much. You provide a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
Value to me, allow me to be a resource and answer any questions that you have. It would be my delight and pleasure to answer these questions about using your IRA. If you want to reach out, I don't know if you guys drop contact information in the show notes, but Adam@midlandtrust.com. You can reach me there, or on LinkedIn you can find me. My direct line, however you want to come to me to ask questions, I'd be more than happy to. But I'm here to help them. The way they can help me is just by learning more about them and the opportunities that they're seeing in the investment, the real estate investment market.
Awesome.
All right.
Chicago Fact, let's do it.
All right, let's do it. This is complete. You're going to be completely guessing here, Mark. I have no expectations.
That's good.
Yeah. So
it's a win-win scenario.
And we'll let you as well, since we had kind of a finance related episode here. So in the US, Chicago has the third largest GDP, right? And GDP is the standard measure for value added created through the production of goods and services during a certain period of time. What was almost, I'm rounding here, Chicago's GDP in 2020? And is that answer 25 billion, 150 billion, 350 billion, or 700 billion?
Oh, it's easy. 700 billion.
And what do you want to go with?
Can I pick the same, or should I go to 350 just to?
You can do the same.
I'm going to heap on 700 too.
700 billion. Nice work, gents. I would not have known that. I would not have known what 25 and 700 seems like the same number to me.
Yeah, I read an article recently with it's funny.
Just another 600 something billion dollars.
Yeah, no, I know what you mean by that. But the I forgot what it was, and this would be an interesting fact we'll talk about later. But we rank up there in front of we're the 7th largest or something like that GDP in front of continents.
Right. Yeah.
It's crazy how much California I think is the largest GDP, third largest GDP in the world or something like that.
Mm-hmm.
Man, you guys know your economics. Nice work.
So
way to finish with a bang.
All right, I'll take it, especially when you set me up to not know it. So it's even better even. So, all right, Adam, awesome show. Thanks for coming on. Adam, you did reach out to us and share some information. That's how we connected. So anyone else that's out there that thinks they could add value to the listeners or know someone that could add value to listeners, I mean, we're always open to finding someone that's great new guests that way. So feel free to reach out. You can find our emails at straightupchicagoinvestor.com or you could find us on LinkedIn. You can find us anywhere. So thank you, Adam. Thank you, Tom. And we'll see you next week.
Thanks, guys.
That's all.